Hello, everybody. My name's Wade Cooper, and be hosting the January monthly market monitor. Um, give this a minute to let everybody come in. While we're doing that, uh, I'm going to show my disclosure here for I'm a registered rep, so I have to show this, even though I'm not going to be showing any specific securities. And I may be overdoing it by showing this, but our Concourse Financial Group prefers it, so want to keep them happy. And I actually, when I put this in last week, um, or the week before, uh, they made me put for institutional clients only, so that's why that's on there, even though the only folks I work with are credit unions. So anyway, I think we can get moving. So let's get started. And we are going to start with the FOMC dot plot from June of 2023. I chose this a couple of reasons. I did the market monitor in August, and this was the latest dot plot. It also nicely kind of fits the halfway point through the year, um, where the committee um, was sitting. Um, so what the dot plot is, so we every yellow dot you see is is a voting member, and then on the green line, that is the median. So what everybody's doing here is making a prediction on where they think rates are going to go, and then the green line is the median of all that, and then the white line is the market. So um, June of 23, they were predicting by the end of 23 that rates were going to be above 5, or above 550. Turns out they were off just slightly. It was a little bit below that. And the market was closer than what this median was. We'll show that in a second. But the reason I like to show this is because we hear a lot about what's going to happen in the future and what everybody's predicting and all that kind of stuff. And a lot of times it's just they miss it sometimes by a lot. But I think it's important because we're always talking about rates and what's going to happen and how do we plan for it and all that. Well, the folks who have the levers, the median is the green line. They're the ones who make the decisions on this. Then there's the market right under it. So if we fast forward to December, the December meeting, you can see the end of 23, all the members are the same, obviously, because it's right at the end. So that's where they all start. And you can see it's just under 550, where the market predicted. And so they were off a little bit. It was only 6 months. So, what I find interesting about this is that you go from 23 to 24. They make the prediction, again, the median of about 4 rate cuts, right under 550 to just above 450. That's what they're predicting is going to happen in 24. And then it's going to keep going to another 4 in 25 is what they're predicting. And let me go back to, I'm sorry, I'm going to go back to June really quick. The reason I want to do that is because from 23 to 24, it's pretty consistent. They're looking at above 550 to just above 450. So that's about the same. The market, however, was about under 550, thinking it was going to go down to 4. So about 6 rate cuts. That was in June. Now in December, they think it's going. The market is predicting closer to 7 rate cuts. And again, we think a lot about this kind of stuff. We go to the next. This is the data that they use for. This is the world interest rate probability. It's the um, so this is the market, not the Fed. So you can see if you look down here at these numbers, the meetings 12, 18, and 24. The last meeting, they're looking to be. These are the number of cuts or hikes. So this is 6.15. And then in January of 25, they're looking to be minus 6.8. So roughly 7. And the implied interest rate be 3.625. Now, what's significant about that, I think, is that again that the what the Fed is saying is that they're looking at 4 rate cuts, and they stuck with that since June. And now the market is saying, well, we think there's going to be more like 7 rate cuts. And I'm not sure who's right. I'm in the. I don't like to make a lot of predictions, but I'm in the higher for longer camp, and we'll talk about that in a couple slides. But I just like to point that out because there is. I mean, they see what these rates are doing. I mean, it affects all of us, right? So. So how do they come to the rates? It's all based on the Fed's dual mandate. It's unemployment and inflation. And again, these numbers are a little stale. I had to put them in December. I was out on vacation last week, so I had to put this together and get it submitted and approved in December. So a couple weeks stale, but this is from November. These are the November numbers of unemployment of 3.7. So as part of the dual mandate is the unemployment. Next is inflation, and you can see how they've, from a year ago 6.5 all the way down to 3.1. Now, what I find this goes into my thinking of the higher for longer, and I can be off by a mile. We got it down to 3. Then we had it popped up a little bit, inflation. Then it came back down a little bit. So you can see in June we were at 3, and now we're at 3.1. But in between there, we were at 3.7. So it popped up a little bit. That's not what the Fed wants to see. Here's the dual mandate, and so I'm just checking my time here. I'm going to try to make this 30 minutes. So we were at 3 points. So down on the bottom is unemployment, and on the left side is the inflation. So we were at about 3.7 for unemployment, and inflation is at 3.1. So we're sitting somewhere, in this neighborhood. And the idea is to get it down into the target. And how do you do that? It's with interest rates. So, we hear terms like the soft landing, and the soft landing is getting inflation down without causing high unemployment. So, or a recession. So if recession comes, unemployment most likely will go up. So what we're trying, what they're trying to do when you hear soft landing, that's what we're talking about, right? get the inflation down without popping up unemployment. So they raised the rates up a lot in a short period of time to get a hold of inflation. It didn't seem to affect unemployment that bad or that much. So again, that's why I'm in the higher for longer. The higher for longer camp is they the inflation might be stubborn, and if they start cutting too quickly, they might have to re-raise. They might have to raise it again. So let's say they cut it 50 basis points, and then inflation goes back up. Well, that means they're going to have to try to get ahead of it, and try to raise the rates again. I could be off by a mile. You know, we've done the crystal ball challenge a couple times, and I'm never even close to the winning numbers. So that's just kind of my rationale for my thinking here. Um, I'm sure if you turn on any TV, you know, any business news station, there's going to be um, differing opinions as to why they need to start cutting. The market obviously thinks they're going to start cutting. Um, and one of the other things I like to point out is um, prior to them raising the Fed raising the rates, they were just saying, oh, this inflation is transitory. It's not going to stick around. It's transitory. Yeah, I don't know if they'll ever use that word ever again because it really bit them, um, came back to bite them. They probably should have started raising earlier. They didn't, so it had to get, you know, the rates had to jump up like they did. And we're going to talk more about that in a second, and the effects it had on credit unions. So the next slide, I actually used this one in August, but it still applies. Waiting for recession. I am not rooting for a recession. I don't know if a recession, when it's going to come. A recession eventually has to come. It's part of the business cycle, so it has to happen. Um, but what's in this table, it's lags from yield curve inversions to recessions. So and the yield curve inversion is, of course, when the shorter term rates are higher than the longer term rates. So the longer, you know, a normalized yield curve would have the shorter rates lower and the longer term rates higher. You know, the idea being if you're putting your funds out a little bit longer, there's a little bit more risk. You should be paid a little bit better. Well, that's not happening right now. We have an inverted yield curve, um, and so the curve inverted on 10/26 of 22, and we still haven't seen a recession. You can see on the left hand side of this table, those are the dates of all the yield curve inversions, and then the dates of the recession is the second column, and then the days it took and the months that it took to get there. At the bottom, you see the averages pre 1985, averages all years, average post 1985. I'm not sure what the magical 1985 number is and why that's there. But I do like to say that, you know, this is a small data set anyway. So you can't really uh, you know, as far as timing conclusions off of it. You can, I mean, what's interesting on this to me is that um, we are in second place. If the recession started tomorrow, we'd be in second place. So we may break the record. This record 16.5. The one prior to that is 14. The yield curve inversion started in October 26th of 22. That's, you know, we're approaching 15 months on that. So we're above the 14, but we're not quite at the 16 and a half. So again, your guess is maybe we'll blow right past the 16 and a half. Um, And that's the other thing. It could normalize before a recession. That could happen. Um, I I'm not going to make a prediction on that, but it could happen. But this is what historically what we've seen. Um, so we are a credit union. All our members are credit unions. So I like to, when I do the monthly market monitor, I like to focus on credit union numbers. Um, these are all from Callahan. I use all credit unions in the nation. Um, you can go on there. I encourage you to go on there and do some of the things uh, with your peer group. Um, but these are all of them. And of course, they're going to, because it's all of them, they're going to be dominated by the larger credit unions. Um, and so what we see is, the name of the game right now um, is liquidity. That's what everybody's talking about, or the lack of liquidity. You can see um, cash balances are this is year over, so third quarter 22, third quarter of 23, and everything we're going to be showing here is from third quarter of 23. We haven't gotten all the fourth quarter data yet. Actually, I don't think it's even been submitted yet, right? Um, so um, that this is the latest data that we got from Callahan. But we're sitting at minus 4.32 on cash. Overall investments down minus 8.27. You can see everything: government and agency securities down, investment in other financial institutions are down, all other investments down. And then you look at the loans and they're up. They're up 9.34, which makes sense. It makes sense that all your cash is leaving and all your investments are uh, going down because it's going to fund loans. So if you have a maturity in a CD or a treasury, instead of reinvesting that, it's usually going to fund some loans. Um, so that makes sense with the loan growth. And then the overall assets are up almost 4% too. So that's, I mean, that part's good news. It's the cash part that gets people nervous. Um, just point out the cash balance of, and I know we got to add 3 zeros on this or whatever, but we'll just call it 30 million on 474. Um, that's just above 5%. I didn't do the exact calculation on that, but um, we're over 5% on that, but well under 10% as far as the cash is concerned. So um, take a look at that. Make sure you have liquidity sources. Um, the next, this is the Fed funds versus credit unions' cost of funds. And um, here we go. Fed funds rate versus credit union cost of funds. Again, all credit unions. Um, you can clearly see where the Fed dropped to 100 basis points. Remember, that was in January of 2020. And here's the pandemic. And all these next slides, you're going to clearly see where the pandemic was. And so here's the Fed was going along, chugging along, going down a little bit, and then we dropped. Here's the average cost of funds for credit unions was below Fed funds for a while. They dropped them to almost zero, and then our cost of funds were a little bit high, and then dipped a little here and kept going down, and then the rates hike started. And there's going to be a lag. Nobody expects you to, if the Fed funds go up 100 basis points, for you to raise yours 100 basis points overnight. So what we started seeing here and what I started hearing, I talk to credit unions every day. So what we started hearing was the loans are, going out. We need more cash, and so the first thing I've been hearing, and still today, CD specials. And what they would find was that the CD specials would not attract a lot of outside money, but it would people had money in their share accounts, and they would just move it over to the CD special. So it's kind of um, just cannibalizing from their share accounts, right? But it's not the worst thing in the world because those are rate sensitive members, so they may have left anyway, or they may have left had the CD special not happen. Um, so anyway, that's what we've been seeing, and this is it's quite a spread between cost of funds and the Fed funds rate, but nobody really expected your ALM model did not have you go up 500 basis points. I mean, nobody's model has that. Um, so it's good they're coming up and tracking a little bit. Obviously the problem with the raising cost of funds is that you need to it cuts in on your margins. You need to have higher loan rates in order to keep your margins up. So um, which leads us to Fed funds versus credit union yields. Um, Blue line, same line as before, is the Fed funds. The yellow line, yield on investments, and the green line is yield on loans. And you can see if you have, the investments is what I handle a lot of. I work with credit unions on their investment portfolio, and if you have a laddered portfolio, you're never going to have the highest rate, and you're never going to have the lowest because you're constantly, um, you know, working your ladder. Something matures, you go whatever the next best rate is, a year out or 2 years or whatever your ladder is. So the yellow line makes a lot of sense to me. Above there, rates drop drastically. Um, your ladder's still above those rates, and then we start coming down. And in this area, we were looking at 0.25 and really, really low rates, I remember at the time. Um, and so when the rates started going back up, you're catching up because your portfolio still has things in it that you invested in back here. So it's catching up. This makes a lot of sense. You can say a little the same thing about the loans, but um, you could see almost credit unions were not, and this is, keep in mind, even the large ones probably didn't raise their rates, their their rates high enough soon enough. Um, and I know we got to take care of our members, and we're here to do loans and not investments. But it's if you run out of cash, um, you're going to have to borrow. And if you borrow, the minimum you're going to be borrowing at is Fed funds. But if you're borrowing, it's going to be Fed funds plus something, right? So um, you realistically, thinking ahead, your loan rates should be significantly above this. And again, there is a lag. The loans you made back here in the low interest rate environment are still on the books, and so it's going to lag a little bit. But and again, this is third quarter. You can see the rates. Fed fund rates are still above. We came up a little bit. Um, Need to keep going up though. So um, you know this slide is my least favorite slide of the presentation. So, but I don't want to avoid the topic either. So let's talk about loans to assets. And this again, third quarter, it's gonna probably go up to the fourth quarter. Um, Usually have a little bit. Well, you could see the where the pandemic was, right? Um, and the loans to assets. this may have more to do with um, all the stimulus money that were hitting your accounts, that were hitting everybody's accounts, and you have all this cash on hand. And so if even if your loan stayed steady and all this cash comes in, then your loan to assets is going to drop. Um, so, um, but realistically, we're approaching. I mean, if we say the pandemic started about here, um, and the fourth quarter of 19 was around here, um, we're looking at pre-pandemic levels. So for loans to assets, that's a good thing. Hopefully, starting to normalize a little bit. Um, I mean, the bad part that's uh, not normal, um, is the liquidity. Um, and you'll see, borrowings to assets, how this is, this isn't a great slide either, but nobody asked the Fed to raise rates 500 basis points either. So um, this is, you can see pre-pandemic, if we go here, there was a little spike, went down, and then the borrowings are going up. Looks like the trend is that they're going to keep going up. The fourth quarter, maybe you're seeing this on your own books, which means, again, the importance of that slide of the loan yields staying ahead of, um, if you have to borrow, make sure that your yields, you don't want to borrow high and lend low, right? You don't want to buy high and sell low. That's not how we thrive here in the credit union world. Um, then the last slide is delinquency. And this is, again, back to pre-pandemic levels. There's always a spike in the fourth quarter. So 18, 19 went down. There's a spike here. Can also see, even during the pandemic, we have a spike in delinquency when people had all the cash and were paying for everything. Fourth quarter spike. This is third quarter. My guess is we're going to be continuing to go up. Again, maybe you're seeing this in your fourth quarter numbers that you're putting together to file. So we'll probably see the spike, and then hopefully you're seeing, we're in the first quarter. Hopefully you're seeing delinquency start to go down now. I mean, we'll see how this plays out, but again, it's pre-pandemic levels. Probably be a little higher than pre-pandemic levels, but I mean, it's a I guess strange time. Even with unemployment is very, going back to the unemployment situation, we don't see unemployment spiking or anything like that. This is just how things work. And then, a former regulator here, I was in delinquent when it's delinquency, it's usually um, either poor or underwriting issues or collection issues, or there could have been, or it's unemployment in the area. Those are usually the top three things we're looking at going in, and if you're having high delinquency. So that's the quality, the asset quality, I guess, that people are going to be looking for. And just keep that all in mind. That's about all I have today. Again, liquidity is the name of the game right now. It's just on the NCUA website. And there was a letter from the chairman, July of 23, regarding liquidity and making sure you have, liquidity in place and contingency plans and things like that. We actually have a liquidity framework review that we're offering to our credit unions now, and we've done. We're starting to see more interest in that. The other thing I'd like to just point out is AL validations. We can help out with that. If you haven't done it in the last 5 years, it's probably a good idea to do it. If you changed ALM providers, it should be within 2 years. And then I always have to point it out. It sounds obvious, but whoever's doing your ALM should not be the same people who are doing your validation. They shouldn't be checking their own homework, right? So we can help out with that too. But please give us a call. And thank you for attending. Have a good one.